Okay, actually the topic equity as found in chapter 5, I have already lectured on this in a continuation of the topic comprehensive income. So anyway, I'll repeat. Equity is defined as the residual interest in the assets of an entity after deducting all of the liabilities. In other words, equity is the equivalent of net assets, meaning total assets minus total liabilities. Although equity is defined as residual, it may be subclassified in the statement of financial position. In a corporate entity, the following subclassifications may be shown separately. A. Share capital. Funds contributed by shareholders equal to the par or stated value. B. Share premium. Funds contributed by shareholders in excess of par or stated value. Retained earnings, which may be unappropriated and appropriated. The holders of instruments classified as equity are simply known as owners. We have the statement of changes in equity. Now, by the way, class, you can find this in chapter 5. The statement of changes in equity is a formal statement that shows the movements in the elements or components of the shareholders' equity. An entity shall present a statement of changes in equity showing comprehensive income for the period. For each component of equity, the effects of changes in accounting policies and corrections of errors. For each components of equity, a reconciliation between the carrying amount at the beginning and end of the period, separately disclosing changes from A. Profit and loss, B. Each item of other comprehensive income, C. Transactions with owners in their capacity as owners, showing separately contributions by and distribution to owners. Then, as part of the statement, we have the statement of retained earnings. The statement of retained earnings shows the changes affecting directly the retained earnings of an entity. The statement of retained earnings is now a part of the statement of changes in equity. The important data affecting the retained earnings that should be clearly disclosed in the statement of retained earnings are: A. Net income or loss for the period. B. Prior period errors. C. Dividends declared and paid to shareholders. Effect of change in accounting policy and the appropriation of retained earnings. Now, with appropriation, you are going to transfer a portion of the unappropriated retained earnings to appropriation. So once appropriated, the amount cannot be declared for dividends. Now, items directly affecting retained earnings, net income or loss for the period. Net income is added because it increases retained earnings, and net loss is deducted because it decreases retained earnings. Prior period errors. The prior period errors are shown as adjustments at the beginning balance of retained earnings to arrive at the corrected beginning balance. The net income of the prior period is understated, the amount of error is added to retained earnings. If the net income of the prior period is overstated, the amount of the error is deducted from retained earnings. Dividends to shareholders. The dividends declared or paid during the year shall be deducted from the retained earnings. Effects of change in accounting policy. This is shown as an adjustment of the beginning balance of retained earnings. If the net income of prior period is understated because of the change in accounting policy, the effect is added to the beginning retained earnings. If the net income of the prior period is overstated because of the change in accounting policy, the effect is deducted from the beginning retained earnings. Retained earnings appropriated. The amount of appropriation is deducted from the unappropriated balance of retained earnings. Conversely, if the appropriation is subsequently cancelled, it is reverted or added back to the unappropriated balance. Retained earnings may be appropriated for the following reasons: legal requirement, as in the case of treasury shares; contractual requirements, as in the case of bond redemption; entity policy, as in the case of an appropriation for contingencies. Now, in the case of letter A, as a legal requirement, if the company reacquires its own shares either through purchase or donation, when the entry is if purchased, debit to treasury shares and credit to cash. At the same time, there must be an appropriation entry debiting unappropriated retained earnings, and appropriation for treasury stock is credited. Now, in other words, it's a legal requirement that the company should appropriate a certain amount of retained earnings, and it cannot be declared for dividends. Now, in the case of bond redemption, usually a sinking fund cash is created for the payment of the bonds payable, and so again, an unappropriated retained earnings should be set up as appropriation for bond redemption, and as well as for contingencies. So, in other words, retained earnings appropriated for several reasons. Okay, so we now go to the problems in connection with the changes in equity. We now begin with problem 5-1. In 5-1, we have reliable company. Okay, so reliable company. Now prepare a statement of retained earnings for 2020. In 5-1, reliable company provided the following information for the year ended December 31, 2020. So we now have retained earnings and appropriated a beginning balance of 200,000. Then the over depreciation of 2019 due to prior period error. Net income for the current year. Retained earnings appropriated for treasury shares. Original balance is 500,000 and reduced by 200,000 by reason of reissue of the treasury shares. In other words, the treasury shares initially at 500,000, 200,000 was reissued. So in other words, the appropriation is also reduced. Retained earnings appropriated for contingencies, the beginning balance of 700,000 and increased by current appropriation of 100,000. Cash dividends paid to shareholders and change from FIFO to weighted average credit. Now that's change in the inventory valuation method from FIFO to the weighted average method. So now we have the statement of retained earnings. Retained earnings on January 1 for 2,600,000. Okay. By the way, we have 5-1 for reliable. Retained earnings on January 1, beginning balance of 200,000. Then we have the prior period error over depreciation in 2019. Now this current year is 2020. If in 2019 there was an over depreciation, meaning that was overstatement of expenses. And if expenses were overstated, meaning the net income was understated, and the amount close to retained earnings last year was understated. So meaning the retained earnings on January 1 is understated by 100,000, so we have to add. Change in accounting policy from FIFO to weighted average method, credit adjustment. Once credit adjustment, we have to add to retained earnings beginning balance. So, the corrected beginning balance of retained earnings, 450,000. Then we have the net income for 2020 of 1,300,000. And we have the decrease in appropriation for treasury share. Uh, Originally, the appropriation for treasury shares was 500,000, but because of the reissuance, then the appropriation is reduced to 300,000. Therefore, the decrease in the appropriation should be added back to retained earnings. Okay, so we now get the total of 1,950,000, and we deduct the cash dividends paid to shareholders in the amount of 500,000, and the current appropriation for contingencies as stated. This was increased by the current appropriation of 100,000. So meaning it will increase the appropriation for contingencies and will decrease the unappropriated retained earnings. So retained earnings by December 31, that is 1,350,000. It's your retained earnings unappropriated. Now we go to 5-2. Again, it's a statement of retained earnings for Gondola Company showing the following charges and credits to retained earnings for 2020. Now we have the balance of retained earnings by January 1, loss from fire, goodwill impairment, stock dividend, loss on sale of equipment, compensation of prior period not accrued, loss on retirement of preference share at more than issue price, share premium, gain on early retirement to bonds payable, gain on life insurance settlement, correction of prior period errors credit, net income for the year of 3 million and appropriated for treasury shares during the year. So we now begin, since the problem is asking for a statement of retained earnings. Before we go to the statement, now first we have to determine the adjusted beginning balance of or adjusted net income. Now, for the net income given is 3 million. That's net income for the year. And then we are going to deduct loss from fire, goodwill impairment, loss on sale of equipment, gain on retirement to bonds payable, to be added, gain on life insurance settlement. So we have now the amount of 3,050,000. Okay, these are shown as charges and credits to retained earnings for 2020. Now we have the adjusted net income of 3,050,000. Then for the statement of retained earnings proper, we begin with the balance in January 1 given at 2,600,000. we have the compensation of prior period not accrued as 500,000. We have to deduct because actually compensation is a charge should have been deducted, however it was not, so meaning it overstated the retained earnings balance of prior period, so affecting the beginning balance. Then correction of prior period error a credit, so we have to add, we have the adjusted beginning balance of 2.5 million. Net income as adjusted computed above of 3,050,000, and we have the stock dividend of 700,000 deducted, as we have to debit it to dividends and credit stock dividends payable. Loss on retirement of preference share, affecting the preference share at more than the issue price, 350,000, and the appropriation for treasury share of 1 million. So the balance retained earnings at the end of the period is 3,500,000. Now it's the amount after uh, recognizing the adjusting entries or the adjustments to net income and to the retained earnings account. Then 5-3, we are going to prepare comparative statements of income and retained earnings. We are now given the following income and retained earnings for 2020 and 2021 with sales and cost of goods sold. Then we have the gross profit and expenses deducted, the net income, then retained earnings on January 1 and add net income. We have the dividends deducted, so that gives us retained earnings on December 31. In 2021, the entity discovered that ending inventory for 2020 was understated by 100,000. So, in other words, it affected the 2020 statement figures. In addition, the entity decided to change its method from double declining to straight line. The difference in the two depreciation methods are as follows. So, in 2020, using the double declining method and compared with 2021 and the straight line method. Expenses in the income statements include depreciation based on double declining balance. So, meaning in the income statement, the expenses figures of 1.8 million in 2020 and 1.5 million in 2021 included depreciation computed based on the double declining method, whereas the company changed its method from double declining to straight line. So we now have the comparative income statement for 2020 and 2021. First, we begin with sales of 6 million and 4.5 million. Then the cost of goods sold figure, we have 2.8 million as given and 2.4 million. So we have the gross income. Cost of goods sold for 2020 is only 2,300,000 because the entity discovered that the ending inventory for 2020 was understated by 100,000. So if the ending inventory was understated, meaning the cost of goods sold was overstated. So an adjustment should be made now, increasing the ending inventory of 2020 to by 100,000. So it will reduce the amount of cost of goods sold to 2,300,000, but it will increase the cost of goods sold figure by 2021. The fact that it will involve beginning inventory now with a corrected figure adding 100,000. So beginning inventory is a plus, so meaning it will increase cost of goods sold. Then for the expenses in 2020, it's 1.8 million for the expenses. However, in 2021, it's 1,500,000. It's now 1,490,000. The change in the depreciation method in 2020, there was a change already. In addition, the entity decided to change its method from double declining to straight line. The difference in the two depreciation methods are as follows. So if in 2020, the depreciation used in the statements was 450,000, whereas the correct amount is 400,000, meaning in 2020, your depreciation was understated, no? Or double declining 450 and the straight line is 400. There was an overstatement by 50,000. And in 2021, the correct depreciation is 340,000 and the depreciation recorded is 350,000. In other words, depreciation was overstated by 10,000 to the extent that the given data in the problem showed depreciation in 2021 by 1,500,000 and 350,000 minus 340,000, meaning there is a difference of 10,000, meaning the expenses in 2021 of 1.5 million is overstated by 10,000. So it's only 1,490,000. In 2020, the books already closed, so the adjustments due to the effect of the change in the depreciation method will no longer be treated as an adjustment to our 2020 income statement. Now, to the extent that in the income statement for 2020, we have sales of 4.5 million, and then we have the cost of goods sold of 2,300,000, and we have the net income computed for 2020 of 400,000. In 2021, cost of goods sold was adjusted, and since the books are still open. Here, the depreciation that was recorded as part of expenses in lieu of 350,000, it's only 340,000. So it will reduce the expenses by 10,000. Now we have the statement of retained earnings as computed for 2020. Statement of retained earnings. We now begin with the January 1 balance of retained earnings of 1 million for 2020, 1,250,000 for 2021. Now let's start with the 2020 retained earnings of 1 million, the beginning balance, and then the net income for the current year. Instead of 300,000, it's 400,000 because of the adjustment to cost of sales and the dividends paid of 150,000. So we now have the retained earnings and 1,250,000 that should be forwarded to 2021. Now, in 2021, we have the adjusted amount of net income that's already 1,610,000. That's your net income as computed for 2021. And finally, the dividends paid of 500,000 was recorded at 500,000. So, leaving the retained earnings by December 31 equal to 2,360,000. 20,000 or in 2020 it's 1,250,000. Now with the results of our net income computed in 2020 that was forwarded to the statement of retained earnings. Okay, now we go to 5-4. 5-4. Here we have prepare a statement of changes in equity for the year ended December 31, 2020. So we have now your statement of changes in equity for December 31, 2020. Now we have the balances on January 1 for the ordinary share capital of 10 million and the share premium of 7.5 million and the retained earnings of 3,250,000. On January 5, Martha issued at 54 per share 100 shares of 50 par 9% convertible preference shares capital. Martha had 250 authorized preference shares. So issued was 100 shares with a par of 50. So it means the preference share, the issuance is at 54. The par is 50. So the par of the preference shares issued was 5 million and the share premium is equal to 4 pesos per share times 100,000 shares. So it's 400,000. Now, on February 1, Marsari acquired 20,000 ordinary shares for 16 per share. Marsa uses the cost method. Now, in this case, 20,000 ordinary shares at 16 equals the amount of, so we have now the purchase of treasury shares ordinary multiplying 16 by 20,000 shares. So we have now the treasury shares at 320,000. So in other words, if the original number of shares issued was 2,000 at 5 nga par, so it gives 10 million. Reacquired now is 20,000 shares. So the outstanding shares of ordinary share capital, the outstanding shares of 2 million is now reduced by 20,000 shares. Then we have another on April 30, Marsad completed an additional public offering of 500,000 ordinary shares with 5 par value. Actually, we have total of 6,000 authorized or ordinary, only 2 million. At 6 million is the authorized. Initially, 2 million were issued. On April 30, Marsa issued 500,000 shares with 5 par value. It was sold to the public at 12. So meaning there was a premium equal to 7. We now record at par the 500,000 shares at par, 2,500,000, and the share premium at 7. That's 12 minus 5 at 7 times 500,000 shares, or 3,500,000. So the total amount received was 6 million. Then dividend to ordinary, we have the on June 17, Martha declared a cash dividend of 1 per ordinary share payable on July 10 to shareholders of record on July 1. November 6, Martha sold 10,000 shares of treasury for 21. Now, actually, there were 20,000 ordinary shares. So, if the total shares initially issued was 2 million and an additional 500,000 were issued on April 30, originally it had 2,500,000 shares. However, 20,000 shares were reacquired on February 1. So the outstanding shares, by the time the cash dividend was declared, the outstanding shares only 2,480,000. And if the cash dividend declared at 1 per share, so we multiplied that by the number of ordinary shares. So we now get the dividend ordinary of 2,480,000. And it was deducted from retained earnings. Then, on November 6, Martha sold 10,000 of treasury shares at 21 per share when it was acquired at 16. So, at 16, now the company is selling 10,000 shares at 21, meaning the total amount received is 210,000. We are now crediting 160,000 to treasury stock. That's only 10,000. Uh, the number of treasury shares is 20,000 that was reacquired on February 1 at 16. So the cost per share is 16. Now reissued was 10,000 shares. So 10,000 shares at 16, our credit to treasury shares is 160, and we have the share premium now for the excess of 5 multiplied by 10,000 shares. So we have 50,000 upon reissuance of the treasury shares. Then we have the dividends on December 7. Martha declared the yearly cash dividend on preference share payable on January 7 to shareholders of record on December 31. Now, with regards to the preference shares, the company had issued a total of 100,000 shares. That was on January 5. And the 100,000 shares, the yearly cash dividend at 9%. So 9% times 50 is 4.50 per share. And we have a total of 100,000 shares. We have 9% multiplied by the power of 50, meaning the dividend per share is 4 pesos and 50 centavos. And then we multiply it by 100,000 shares. So we now have pesos uh, recognized as dividends on preference shares. So we now debit to retained earnings for 450,000. It was to be recorded on December 31, 2020. Next, the on January 17, 2021, before the books were closed for 2020, Martha became aware that the ending inventory on December 31, 2019 was overstated by 200,000. When it was overstated, the effect of that is the ending inventory was overstated, so it reduced cost of goods sold, and it became the beginning inventory of 2020, increasing cost of goods sold. So the overstatement of the 2019 ending inventory in the amount of 140,000 overstated by the after-tax effect on 2019 net income was 140,000. The appropriate correcting entry was recorded. So we now have the overstatement of 2019 ending inventory. We deduct from retained earnings the amount of 140,000. That's after tax. So meaning there was an income tax effect. Now, possibly the income tax is, the rate is 30%. So the after-tax effect is 140,000. We are deducting it from retained earnings for 2020 in the amount of the beginning inventory was overstated. And so the retained earnings was understated, no? To the effect that the after-tax effect on 2019 net income was 140,000. Now let's try to analyze if the ending inventory on December 31, 2019 was overstated, meaning ang cost of goods sold was understated for 2019, and so the net income was overstated. So the 2020 beginning inventory was overstated. So the cost of goods sold was overstated because of the beginning inventory that was overstated. And so the effect of the overstatement of the beginning inventory in 2020 is to overstate cost of goods sold. So we have now the overstatement of 2019 ending inventory in the amount of 140,000. We are deducting 140,000. Then the net income for the current year is in the amount of 2,250,000. After correction of the beginning inventory, net income for 2020 was 2,250,000. So we add this to retained earnings. Now we have the balances on December 31, 2020 for the ordinary shares. Then we have the preference, share premium, retained earnings, and the treasury shares. So we have now the statement of changes in equity, specifically on the balances of retained earnings. Now we go to problem 5-5. Problem 5-5. The problem is asking now for statement of changes in equity for 2020. So we now begin with balances, statement of changes in equity for the ordinary shares, preference, share premium, retained earnings, and treasury shares. So the balances on January 1 for the ordinary share capital, 5,150,000. Preference shares, 1,800,000. The share premium is given for ordinary 3,500,000. On the preference, 90,000. So we add 3,590,000 is the total. Then retained earnings, beginning 4 million, and treasury shares ordinary on ordinary share capital 270,000. Then we have the retirement as stated on January 1, 2020. Car had 100,000 authorized shares of 100 par, 10% cumulative preference share capital, and 3 million of authorized shares of no par ordinary share capital with a stated value of 5 per share. So that's now with regards to the capitalization of this ordinary share and authorized preference. So on preference, my 100 authorized 100,000 shares with 100 par. And for ordinary, it's 3 million authorized shares. January 10, Carr formally retired all the 30,000 ordinary shares of treasury. So we have retirement of treasury shares, the amount of 270,000 should be written off since it was the balance of treasury stock. And we have now the retirement for the 30,000 ordinary shares, and the par per share is 5. And we have 30,000 ordinary shares retired at 5. It's 150,000. And so the share premium with a balance of 120,000. So we now deduct the ordinary share with a debit of ordinary share 150,000 and the share premium of 120,000. Supposed to be a credit to treasury stock for 270,000. We have the treasury shares had been acquired in the previous year and were originally issued at 10 per share. Now that was the previous year when the treasury shares were originally or the shares were originally issued. Carr owned 10,000 ordinary shares of Bush Company purchased several years ago for 600,000. On February 15, Carr declared and paid a dividend in kind of 1 share of Bush for every 100 ordinary share of Carr held by a shareholder of record on February 28, 2020. The market price of Bush share was 75 on February 15, 2020. Our company is Carr, and Carr owned 10,000 ordinary shares of Bush Company, purchased several years ago. And now with the property dividend, on February 15, Carr declared and paid a dividend in kind of 1 share of Bush for every 100 ordinary shares. So we have a number of shares is 10,000. So for every 100 ordinary shares of car held by a shareholder of record, and the market price of Bush share was 75 on February 15, 2020. So we have now the property dividend of 750,000. That's equal to 75 multiplied by the total of 10,000 ordinary shares, and then for every 100. So meaning we have to consider the number of ordinary shares of Bush, and the dividend per share. That's now the market price of Bush share was 75, leading to 750,000 of the property dividend. Then the dividend to preference, that's on December 12, CAR declared the yearly cash dividend on preference share payable on January 14 to shareholders of record on December 31. The preference share capital is 1,800,000. It's 10%. So 10% of 1,800,000 given is the 10% cumulative preference share. So multiplying 10% by 1,800,000, the dividend to preference is 180,000 debited to retained earnings. Now for the error, on January 15, before the accounting records were closed for 2020, Carr became aware that rent income for the year ended December 31, 2019 was overstated by 500,000. The after-tax effect on 2019 net income was 350,000, and the appropriate correcting entry was recorded. So the error now will be a reduction in the retained earnings because it was an overstatement of rent income. So net income for the previous year was overstated, and the after-tax effect is 350,000. So we have to deduct the correcting entry. Then the last is net income of 2.6 million. So we have now the balances of the equity accounts by December 31. Next, we go to 5-6. United Company reported the following unadjusted current assets and shareholders' equity at year-end. So what amount should be reported as total shareholders' equity at year-end? So we have now the amount for 5-6. The total shareholders' equity is 7,500,000, and then we deduct 300,000. Now the difference is 7,200,000. Take note that we have the shareholders' equity, share capital, 5 million, share premium, 2 million, retained earnings, 500,000. So all in all, we have 7,500,000 for the share capital. Then we have to deduct the amount of 300,000 for the financial assets at fair value, including cost of 300,000 of United Company shares. So we have now this treasury shares of 300,000. Now we deduct. So the answer is A. Then we have 5-7. The answer is the company provided the following information at year end. So what is the shareholders equity question at the end of the year? So we have now the share capital 6 million, share premium 3.5 million, uh, cumulative translation adjustment 2 million, so that's 7.5 million. Treasury shares at cost 700,000, 6.8 million. Retained earnings 1.5 million, so that gives us 8 point 3 million. And cumulative unrealized gain on option contract designated as cash flow hedge. So we have now the amount of 8,900,000. Okay? So how did we get 8 million there? 900,000. We add 6 million, 3.5 million. So that makes 9,500,000. Then we deduct 2 million because it's a debit. We have a difference of 7.5 million. 7.5 million, and then we deduct the treasury shares. We have 6,800,000 and retained earnings of 1,500,000. Total is 8,300,000, and the unrealized gain of 600,000 on option contract designated as cash flow hedge. So we have now 8,900,000 in the case of letter B. Then in 5-8, Silver Company provided the following information at year end. What is the shareholders' equity at year end in problem 8? First, we have to compute for the amount of net income, so sales of 10 million, and deduct the total expenses, so the net income of 2.2 million. To net income of 2.2 million, we add retained earnings beginning of 1 million, and we deduct dividends of 700,000. So retained earnings on December 31 is 2.5 million. We have the preference share equal to 2 million for the par. Then we have the ordinary share capital 3 million at par. Then we have the share premium at 1 million. That's the given amount of share premium. Then retained earnings of 2.5 million computed above, and we deduct the treasury shares of 500,000. Accounts payable is not needed. So total shareholders equity of 8 million, that's letter A for 5-8. Then 5-9, the amount should be reported as shareholders equity at year end. So in 5-9, we are going to determine the shareholders equity at year end. So share capital 15,000. Then we add the share premium of 15 million. Share premium add 5 million. Retained earnings unappropriated is 6 million. Then we have the retained earnings appropriated for 3 million. Cumulative translation adjustment it's a credit. We add 1,500,000. Actuarial loss fully recognized in OCI. It's a deduction by 1 million, and we have the treasury shares at cost. We deduct 2 million. So the difference now is the shareholders' equity at year end equal to 31,500,000. 31,500,000. Okay, so we have now number 10. Number 10 is in the form of theory. So in number 1, the answer is A. In the statement of changes in equity, the effect of a change in accounting policy is presented separately for each component of equity. Then number 2, in the statement of changes in equity, the effect of the correction of a prior period error is presented separately for each component of equity. Which of the following does not appear in the statement of retained earnings? So in number 3, it's other comprehensive income. Does not appear in the statement of retained earnings. Number 4, which of the following would appear first in the statement of retained earnings? Now, the prior period error. And number 5, correction of errors in prior period are included in retained earnings. Okay, so that ends our discussions of chapter 5. I hope you will review and consider whatever questions you can ask questions next meeting. Though I have already given you as assignment chapter 17, but only for the theory. I did not give you questions, problems. Okay, so we have now chapter 5. Okay. Linsa, 17. 17. Dash one. Okay. Now, since I still have time, then I will already begin with some problems in chapter 17 related to the cash flow statement. Now, in 17-1 for Mountain Company, required is determine the cash flow from operating activities using the direct and the indirect method. We have now the statements to be used here. So we have to determine the net cash provided by operating activities by using the direct and the indirect method. Okay, so but before we go to this, let's try to analyze on January 1. We have accounts receivable on January 1 amounting to 440,000, and then that's found in January 1 accounts receivable. Then we have sales for the period for 4,500,000. So the total of 4,940,000. Deduct accounts receivable of December 31 of 540,000. And we have the write-off of accounts receivable amounting to 10,000. So we are going to add back write-off. So the total is 550,000. The collections from customers of 4,390,000. Then also we will determine the payments to merchandise creditors. Accounts payable on January 1 amounting to 160,000, and then we add purchases of 2,850,000. Then the total, we deduct accounts payable on December 31 of 280,000. Then the payment to merchandise creditors, 2,730,000. Then for also salaries, the amount of salaries paid, 600,000. We add accrued salaries beginning of 80,000 and deduct ending of 50,000. We have now the payment for salaries. Next, insurance. We have the amount of insurance expense of 20,000. Then we add prepaid insurance on December 31 for 15,000 and deduct the beginning balance of 10,000. So we have now the amount of payment for insurance for 25,000. Now, using the direct method in preparing the statement of cash flow, we are going to start with cash received from customers as computed above. Then we have to deduct cash payments, 2,730,000. Then we have the salaries paid, we have insurance paid, rent paid, other expenses paid, net cash provided by operating activities for 655,000. Now, using the direct method. On the other hand, with the use of the indirect method, then we have the net income given at 450,000. We have to deduct increase in accounts receivable. So we have the accounts receivable increase. Actually, it's 440,000 and 540,000. So there is an increase of 100,000. However, there is also an increase in allowance by 20,000. So 100,000 minus 20,000. The increase in accounts receivable at net is 80,000. And we have to deduct. Actually, uh, current assets increases should be deducted. Current assets decreases should be added. So we have decrease in inventory for 100 50,000, we are going to add. Increase in prepaid insurance, we deduct by 5,000. And we have now increased in accounts payable for 120,000. So accounts payable is current liability. If you have an increase, then it will be here, increase in accounts payable is to be added. Decrease in accrued salaries payable by 30,000 is to be deducted, and depreciation is to be added. So the net cash provided by operating activities is the same as that under the direct method. In other words, if you only involve operating activities, whether you are using the direct method or the indirect method, the amounts of net cash provided or used by operating activities will be the same. And under the direct method, we only consider cash received, add, and then we have all payments, deduct. That's why we only have receipts and disbursements, why we call it direct method. The only thing is you first have to compute for the receipts and the payments. Now, on the other hand, if you are using the indirect method, you should begin with net income. So we have now to have net income, and then we are going to add back the non-cash expenses. So to net income, you are going to add back depreciation expense and amortization expense. And if you have losses from sale of equipment or anyway, whatever amount of loss, now this should be added to your net income. So meaning we add back the fact that in computing net income, we deduct depreciation, we deduct amortization, we deduct loss. However, with regards to cash flow, depreciation does not involve cash payment nor amortization and loss. That's why you have to add back to net income whatever is the amount of depreciation and similar items, so that your cash will be returned. The fact that, again, in computing net income, you deducted depreciation. However, depreciation does not involve cash payment. So you have to add back depreciation. You will be computing for the cash flow. So net income, we add back depreciation, amortization, and losses. And we deduct the possibly, if we have gains, we deduct from net income. Okay, now that's with regards to your adjustments to net income. Then likewise, we have to add decreases in current assets and increases in current liabilities. So you have to add decreases in current assets and increases in current liabilities. And also, we have to deduct increases in current assets and decreases in current liabilities. Now, this is the initial format to be used in computing your net cash provided or used. So you can look at the indirect method now. You will observe that it follows the sequence of the formula I have given. A net income, 450,000, and then you add back depreciation. Add back, no? Then, you also add decreases in current assets, including decrease in inventory, you add. And you have the amount of 150,000. And then you also add increases in current liabilities for 120,000. Likewise, you are going to deduct increases in current assets, including increase in accounts receivable, you deduct, increase in prepaid insurance, you deduct, and also deduct decrease in current liabilities. So, finally, you will have the net cash provided or used by your operating activities. Okay? So, at least you are now guided accordingly. I'll repeat the formula for the operating activities in the preparation of the cash flow statement using the indirect method. I'll repeat the formula for the indirect method. Net income, add back depreciation, amortization, or losses, and other similar items. So you add back because they do not involve cash payments. Then you deduct whatever ginansya, gains. And then, likewise, you are going to add the following decreases in current assets and increases in current liabilities. So, add decreases in current assets and increases in current liabilities. And deduct increases in current assets and decreases in current liabilities. So deduct increases in current assets and decreases in current liabilities. So the difference is net cash provided or used by operating activities. So in the problem, you have the net cash provided by operating activities. Now, if the positive items total exceeds the negative items total, you call it net cash provided. If the positive items total exceeds the negative items total, you will have net cash provided. However, if the negative items total exceeds the positive items total, then you will have net cash used by operating activities. So it's either net cash provided or net cash used by your operating activities. We are just starting with operating activities. Okay, we now go to problem 2. Prepare a statement of cash flows for the current year using the indirect method. So using the indirect method in 17-2, cash flow from operating activities, we have net income 1.5 million. Okay, you have the given amount for net income of 1.5 million. So we begin with it. And then based on the formula I have given, accounts receivable, the amount was a decrease, no? So accounts receivable decreased here or increased, I'm sorry, accounts receivable increased by 650,000. That's why we have to deduct based on the formula I have given. Accounts receivable increase is an increase in current asset. So we have to deduct. Then we have increase in inventory for 750,000. Again, we deduct. It's an increase in current asset. Then prepaid expense decreased by 50,000. It's an increase in current asset. So we have to add. And then accounts payable increased by 250,000. Increase in current liabilities should be added. Decrease in accrued expense by 150,000. A decrease in current liability, deduct 150,000, and we add back depreciation. It's okay that you will write depreciation next to net income based on the formula I have given. So you may state net income 1.5 billion million, add depreciation. Anyway, the effect will still be the same. So we have now the amount of 600,000. 600,000. That's your cash provided by operating activities. Okay? So, net... Di oras siga. Gared pa ya.
Na wifi.
Na mag-brown out. So, ay nag-isigahaw. Ang patay na da. Ang emergency light. Right? Let's continue. We now have the net cash provided by operating activities in the amount of 600,000. Again, it's cash provided because the positive items, the total exceeds the total of the negative items. Then second, we have the cash flow from investing activities. Now, it was mentioned in the PowerPoint presentation that investing activities are related to non-current assets. So, purchase and the sale or disposal of the non-current assets. So, we have now the purchase of equipment in the amount of 1 million. If you have equipment of 4.3 million beginning, ending is 5.3 million. So we have now your equipment with an increase of 1 million, meaning we involve purchase. That's why it's a negative item. Then we have the cash flow from financing activities. Now, financing activities are in relation to long-term liabilities and shareholders' equity. So, long-term liabilities and shareholders' equity. So, we have the issue of share capital for 4,250,000 to 4,750,000. We have now the issue of 500,000. And the payment of cash dividend, actually it's stated to be 300,000. So we now have the cash flow from financing activities with net amount of 200,000. Again, we have discussed that financing activities are in relation to non-trade liabilities and shareholders' equity. So we have now your amount of 200,000 from financing activities, 600,000 minus 1 million plus 200,000. There is an amount of 200,000 which is negative. That shows decrease in cash and cash equivalents. Now, the cash and cash equivalents on January 1 is 950,000, and the ending amount is 750,000. So, you have now proven that your cash and cash equivalents at the end of the year and at the beginning of the year, you have correct amounts. All right, so for 17-2, now we go to 17, 17-3. Okay, let's take up 17-3. Prepare a statement of cash flows using the direct method and compute the cash flow from operating activities using the indirect method. So in 17-3, let's begin with accounts receivable, beginning 210, ending 370. So we have an increase of 160. Accounts receivable January 1, 210, and we have sales of 4,450,000 in the income statement, and the total we deduct accounts receivable at the end of 370,000, and we have the amount of 20,000 shown as the write-off. So we have the write-off of accounts receivable given at 20,000. So the collections amounted to 4,270,000. Then second, accounts payable beginning 345,000, and then purchases 2,630,000, and we have the total. We deduct accounts payable on December 31 of 400,000, the payments to creditors of 2,575,000 for payments to creditors. Then for salaries, the amount of 640,000. Then we have salaries payable 40,000, beginning and ending of 70,000. So the difference is salaries paid of 610,000. Insurance, the amount of insurance paid is 100,000. Then we have your insurance prepaid by December 31 for 80,000. That's your ending. And beginning, we deduct the amount of 90,000 for prepaid insurance. So, the insurance paid is 90,000. Rent paid is given at 350,000. Then for interest expense paid of 40,000, and then we have accrued interest payable. We deduct the amount of 5,000 accrued interest payable. So the amount of interest paid is 35,000. Now, we have your income tax. The amount paid is 200,000. Add income tax beginning of 15,000, ending deduct 35,000. So the income tax paid is 180,000. Then we involve the original entries, debiting to retained earnings and crediting to cash the amount of 160,000 for the cash dividends. Then debit to profit and loss, credit retained earnings for the net income. And then we debit to cash 110,000, debit accumulated depreciation 140,000, credit to equipment 190,000, and credit gain on sale of equipment for 60,000. In relation to data number 2, equipment costing 190,000 with accumulated depreciation of 140,000 was sold for 110,000. In other words, there is a gain on sale of equipment in the amount of 60,000. Okay, the amount of 60,000. Next, we have depreciation in the amount of 260,000, and we credit to accumulated depreciation given 260,000 for depreciation. Then we have equipment 4,300,000 minus 3,430,000. Okay, so 4,300,000, and we deduct 3,430,000. We have now the amount of equipment purchased for cash of 870,000. Debit to cash, credit to accounts payable in the amount of bonds payable 600,000, and credit to bonds payable. Debit to treasury shares 140,000, and credit to cash. Now we have this statement of cash flows using the direct method based on the above computations. Based on the above computations. Then we have now your cash flow statement using the direct method and using the indirect method. Now you study the solution for problem 17-3. Okay, we are going to continue with this on Thursday. Okay? So, araon 17-3, study the solution. We are going to continue discussing the other problems next meeting. Okay? So, good night and God bless all of us. Thank you. Converting.